Thank you very much for coming out, spending your time with us on a Saturday. It's my pleasure to present the Argent story. I really want you to take a look at that tagline, income, growth, and value, and just think of the numbers 10, 10, 100. And I'll get to that right away here. Just skip this, blah, blah, lawyer stuff. Argent Energy Trust. The income, we're generating an income, a distribution that comes back to the shareholder of 10%. That's $1.05 a year paid monthly, just like the old trusts. And I'm not going to get into what Flaherty did with the trust, but suffice to say, when Flaherty shut the trust down in 2006, he did not shut this down. So we're not a loophole, we're not anything fancy. What we do is we have foreign assets in Texas, black gold, Texas tea, that we bring cash flow back into Canada. So for CRA, or the Canada Revenue Agency, we are creating incremental revenue for the government. So the likelihood that we would be shut down or changed is highly, highly unlikely because it's incremental to the government. The reason they shut it down was because companies like Encana, RBC, were looking to convert into trusts and reduce the corporate taxation. We create new revenues for the government. The other 10% is production growth. So not only am I going to pay you a 10.5% yield, I'm also going to show you per annum growth of 10%. And I'm going to do it all by living within my cash flow, the way you should do it. Many of my peers out there are spending above their cash flow. So I can pay the distribution, and I can give you 10% growth, and I can do it living within my cash flow. That's where the magic is. And it can only be done because these assets are in Texas, and I'll get into how that plays. Currently, we're 5,200. As Eric mentioned, we IPO'd in August of last year, August 10th. We were 1,600 barrels a day. Within the first 2 months, we drilled 3 wells. We grew 600 barrels a day to 2,200. Then we purchased an acquisition called Energy Quest, which added 900 barrels a day to us. We were up to 3,100. We then drilled another 3 wells, grew another 700 barrels a day to 3,800. And then we did an acquisition that we had the benefit of being shown to by a very desperate seller who wanted to beat the fiscal cliff in the U.S., and we added another 1,400 barrels a day. So in less than 5 months, we have more than tripled in production, and we have doubled in market cap. We started a $250 million raise in August. We are now close to $500 million in market cap, and we've more than tripled our production to 5,200 BOE a day. As importantly, an 18-year reserve life, which is well above the average of 12 to 14. So we have a long set of reserves to sustain that distribution and to invest and grow. Our production for 2013 is expected to be 55 to 5,600, which means we're going to show you that growth I spoke of. And all our assets are currently in Texas and Oklahoma. We operate 96% of what we have, so we are not open to anyone else's views. We control our operating costs, we control our production, we control our staff. And the next point is really critically important. We are fully operated. We have 20 full-time Argent Energy Trust office staff in Houston and 40 staff in the field. We're not non-operated, we are 100% operated, which allows us to control our own destiny, which is critical in this game. You can read this stuff. I'll just draw your attention to the middle point there, which is our current debt. Our current debt is $55 million on a line of $95 million. More importantly, we're going to generate about $90 to $100 million of cash flow this year, which means our debt to cash flow ratio, which is critically important, is only 0.5. My comparable Canadian peers are 1.6 to 2 times. And in fact, there are other peers out there that are up to 4 times. What that allows me to do is have flexibility to increase my capital program for drilling or purchase something if I desire. But it also gives me the flexibility that if anything goes wrong, that I'm not against the wall. I always have access to capital. If you go down a little bit further, you can see once again, we have an 18-year reserve life. But if you look at the very bottom on drilling locations, we have 152 drilling locations at least. I'm drilling 12 wells this year. 10 Austin Chalk and 2 Eagle Fords. So I have a drilling inventory in excess of 12 to 15 years with my existing asset base. So we think that we really have a 3-legged strategy here. With our existing asset base, we certainly believe we can sustain this model. We have an Eagle Ford opportunity, and I'll get to that very shortly here, that allows us to more than double or potentially triple the size of the company. And we have capacity to access capital so we can acquire so that we can further grow through that. And again, all while paying you 10 to 10.5% and growing at a 10% rate. Here's the magic. If you only remember one slide, make it this one, because this is the real difference on what happens. In the US, we get 2 significant advantages. If you see the netback over there, the netback is really the profit per barrel. So when we drill an oil well, Argent, we make $70 plus profit per barrel on our oil. In Canada, and I've used Crescent Point here, so one of the best Canadian producers that has the highest number. I'm not using the Canadian average, which is 28, but the kind of oil that Crescent Point produces, they make $45 a barrel. The difference is, if you take a look where it says $90 WTI, my assets are on the Houston, Texas, Louisiana coast. That means I get Brent pricing or world pricing, which is $10 above WTI. Unfortunately for Canadian producers, they have to get their oil from Alberta down through the U.S. to Oklahoma, strangely where West Texas Intermediate is priced. Strangely, Cushing is the pricing point for West Texas, even though it's called West Texas. So Canadians get a $10 to $15 discount. So if you're in Canada, you get WTI minus 15. If you're in Texas, you get WTI plus 10. So it doesn't matter who I am, it matters where I am. I get $25 a barrel more per a $90 barrel of oil. That is a huge advantage. I pay the same royalties, and my G&A is about the same, but my operating costs are half what a Canadian producer is. Why? Winter is a lot milder in Texas. Winter, I don't have heavy equipment. I don't have breakup. I don't have the hard freezing that I need to drill. I have year-round access. That's the huge opportunity here, and that allows us to generate recycle ratios of 3 to 4 times. That's money that comes back to you, and that's the advantage of having these Texas assets. I'll quickly go through the leadership team here. I'm the CEO and director. My background is I'm a geological engineer with an MBA and a CFA. I spent 12 years at Shell drilling wells, both domestically and internationally. I ended up in capital markets. I then moved to Talisman Energy, did mergers and acquisitions and strategic work. So 15 years, 16 in the industry. Then I moved over to the dark side. I was an analyst with Peters & Co. Some of you may remember me there. I spent 6 years with Peters. I was covering large cap Canadian, large cap US, and royalty trusts. Boy, that worked out really well, didn't it? And then I moved over to do work with Canaccord and National Bank as an investment banker and equity salesperson, and then finished off with Daylight until they were sold to Sinopec, and then I joined up with Eric Tremblay. Eric Tremblay, you may remember Eric's father, Marcel, started Enerplus with one of our directors, John Brusa. Eric joined his father, and for 13 years they grew that company from 80 million to 8 billion, share price 12 to 64, and about $28 a distribution. So the management team we have is great. Rick Loudon is our president. What we did is we bought an existing company that had been around for 9 years, and we converted it into a trust, as opposed to a bunch of Calgarians going down and buying an asset and letting somebody else run it. We think that is a critical defining success factor, having a 100% operated team, a team that's been together for 10 years plus, that has industry understanding and expertise down there. If we need to cross a highway, we know what sheriff to call to get it done. In Calgary, I don't. That's why I have those guys down in Houston. The structure I won't linger on, but just suffice to know, the distribution that I pay, it's not a dividend, it's a distribution. 2/3 of that is return of capital. That's only, you pay capital gains on when you sell your shares. Only 1/3 of the distribution is interest income. So if it's a taxable account, you only have to pay tax on 1/3 of the distribution I bring up to you. We can talk about it, we're off to the side here. I don't want to get into it. We only pay 2% corporate tax. Again, that's what makes this work. The only thing I'll get you to do is the other key factor is, remember I mentioned we're really low on debt. We're 0.5 times debt to cash flow. The other point up there is the hedging program. We actually have the mandate to hedge up to 70% in our first year, 60% in our second year, 50% in our third year. What that means is currently I'm 65% hedged on my oil at $90 WTI plus a $14 differential. For 2014, I'm 40% hedged right now. So that means if oil price drops, I'm protected. That means your distribution is protected. We think that's critically important. Again, it gives us optionality. These are our assets, and I'll go very quickly here. All the dots are the fields that we have. What I want to show you here is we don't have any single field that if it goes down is catastrophic. Our fields are generally 400 to 500 barrels a day per field, and that means we have diversification of field. You'll also notice the pie chart. I have diversification of production. People say gas sucks. Fine. But you know what? I don't know what the price of oil is going to be. I don't know what the price of gas is going to be. I want the flexibility. I want the diversified portfolio to have both gas and oil. You notice on revenues, though, my oil generates 85% of my revenues. So that's really the key to this story. And I won't go through the rest of it here. I'll just flip over to the summary. The Eagle Ford is one of our key assets. We have 100 locations here. This is what we're doing. We can talk technically, but basically we're running deep horizontals. They're about 9,000, 9,500 feet, and a 5,000 to 6,000 feet laterally, and we can talk about that after. This is our Eagle Ford asset base. Again, 25 Austin Chalk locations, 100 Eagle Ford locations. This is the acquisition we did in December. Important here, this generates $25 million of cash flow. It costs us $3 million to maintain it. This is the acquisition we did in October. It generates $18 million of cash flow. It only costs $2 million to maintain it. That ensures your distribution. Gas we won't talk about because nobody cares. This just gives you a sense of the sensitivities. You can see on the left chart that we are below sustainability. That means our peers spend 130% of their cash flow and do their capital program and their distributions. We spend 95%. And that's the key. That's what makes it sustainable. So a comparative chart in the summary here. Again, just remember, folks, 10.5% yield, 10% growth, and we do it by living within our cash flow. Thank you very much.